All right. Well, welcome everybody to week 3, module 2 review. I'm excited to go through this. I think we've got some really good stuff to share with you guys today, prepping you into module 3. I know some of you have already gone into module 3, but we have some new content up there, and I'll be directing you to that at the end of this as well. So, excuse me. So as far as the new portal content, key terms in real estate education resources, Lindsay actually attached this to the email that we sent out after week 1, just in case you missed it. It's now in the resources section in section 2.3. So if you missed it, it's an entire list of key terms that you should know, and then educational resources, including podcast, books, etc. So it's a really great, it's a couple of PDFs. So certainly go look for those if you haven't already. And in general, the download section, please make sure you're looking in those. We are regularly adding content to the lessons and adding to the download section. So make sure, especially if you're going through a lesson, that you scroll down and you look in the download section and see if there's any ancillary materials to support it.
Michael just recorded 2 new videos today, so Lauren's uploading those. So yeah, every week we're just doing more and more, so there'll be more content all the time.
Yeah, so new content 3.2. So as you go into module 3 for this coming week, 3.2, 1, 2, and 3, so Michael is like a master underwriter. I'm sorry, it just wants to go ahead on me. Michael's kind of a master underwriter, and he gets really deep into the synthesis tool into underwriting, which is something you guys should know how to do. That said, you don't need to do it on every property you look at. If you do, you'll spend your entire life just underwriting properties, and that's not going to work. So 3.2.1 really goes into the way that I look at my numbers, which is very quick. And we're going to, at the end of this today, I'm going to show you how I look for rentals on a very high level. And then 3.2.2 and 3 are really deep underwriting into single family homes. So you're really going to get both sides of the coin through those modules. So make sure, especially if you've already gone ahead, that you go back and you review those. They're very, very helpful.
This is where the action actually, I mean, a lot of us are in medicine, right? So you learn about it in textbooks, but until you actually start to see it and apply it, it doesn't feel real. So the videos of going into the deep dive underwriting, please make sure that, you're looking at those to understand it better.
And Irfan, I know you just came in, but I wanted to reiterate, we've got some new content in module 3. So you can rewatch the recording if you want to hear more, but good morning. Can you hear me? There you are. Good morning, Irfan.
There we go. Bright and early for you.
Can you hear us?
I don't think he's on mute. Here, let me type in the chat.
All right. Well, this is a quote I came across that I just wanted to share because I've been reflecting quite a bit. I speak to people interested in investing in real estate all day, every day. So something that's been really, kind of on the top of my mind lately is, the fact that you all taken the time and to invest in yourself in this way and actually think about being intentional with your investments and the way that you're going to position your portfolio going forward. The vast majority of people, and let's say 99%, they'll invest in their 401k, they'll do some investing in some brokerage accounts, and then they'll just kind of do what they were told to do and in lockstep with what they were told to do from childhood. And the fact that you guys stepped out and took the time and energy and invested in this way, I saw this quote and it just kind of reminded me of it because I love Oprah. I mean, I think who doesn't, but creating the highest, grandest vision possible for your life. And I don't know why I keeps doing this. I apologize. Create the highest, grandest vision possible for your life because you become what you believe. And I think that, again, the fact that you guys are taking the time to actually learn this and invest in this way just shows that if you continue to educate yourself, you'll continue to believe in what you're becoming, and it all just kind of comes to fruition and manifests. So I just wanted to share this quote because that really struck me this week. And the other thing that really struck me this week, I wanted to share with you guys is I was paying my life insurance bill. a small policy I have on myself, and reading through what it was being invested in. And this is a government money market fund, and one of a fund run by BlackRock. Now, this particular fund is a government fund that invests, primarily in debt instruments. But I want you guys to know, and maybe some of you already do know, like BlackRock is out there buying single family homes and competing with us using our money. So I guarantee your 401k and potentially your stock portfolio is invested in some BlackRock funds, and they're literally taking your money and competing against you in the real estate market. I in Florida, in the area where I know, my agent has told me he has been contacted by, representatives of the BlackRock, these big fund teams. They are using our money, and they're going out and they're buying mass loads of these homes that I'm trying to buy.
Generally, they're more in appreciation heavy areas. They're definitely not doing it like where I live in northeastern Pennsylvania or to any extent where it's much of a competition. But yes, they're out there in probably California, New
Yeah,
York
they
area.
are. So I just want to like remind you of why you're doing this. And this land grab that they have, and many of these other funds have, that they're again using our money to compete against us. This is not going to stop. This is going to continue for a very long time. And as we've said on previous calls, I think our children in 20 years are going to have a much harder time buying land and property than we are. So I think the fact again that you guys are taking this time um, to get in now is really fortuitous and advantageous. So I just wanted to share because it hit me. I'm like, God dang it, that I know that I'm competing against them. Again, not this particular fund, but they're out there buying. Any questions so far before we jump in? Okay. Module 2 hit on like ways to invest in real estate. We wanted to create a high level active versus passive, just so people can understand what are your options out there. There are plenty of people that dive into this material and they say, I don't want to be active at all. I don't want to sign on any loans. I didn't even know passive was an option. For me, actually, when I started, I didn't realize passive investing was an option. I just started buying our own single family homes, and then I realized, wait, I can invest passively. So it's important to know your options so that you can make the best decisions for yourself. And then just reiterating the quote, 90% of all millionaires became so through owning real estate. More money has been made in real estate than all other industrial investments combined.
I use that quote all the time. I love that quote.
That's good. And then the other thing is you don't have to be great to get started, but you have to get started to be great. And I think that's a big thing too. So many people just sit on this information and just don't get started. And so just bear in mind, it takes the reps in order to become great.
My son and I, Luca, my 7-year-old, we were talking. I don't know how the conversation got brought up, but we started talking about electricity, and he's like, "Where did it come from? How is it made? Who created electricity?" And I was telling him about how Thomas Edison was trying and trying and trying for so long. It took 10,000 failures till they finally got electricity right. So you just need to get started and you just need to keep trying. You're going to hit a lot of roadblocks for sure, but you'll get there if you just keep having the determination and grit to go forward.
So module 1, we're starting with passive investing, and Taylor, Junko, I know that both of you had made passive investments. Have anyone else on this call outside of REITs? Perhaps you bought some publicly traded. Has anyone else on the call invested in syndications or done any private money lending? No. Okay. Okay. Well, ask any questions as you go. It's pretty self-explanatory, but we'll go through it anyway. Again, passive investing offers the benefits of real estate without having to get directly involved in the day-to-day activities. I can't tell you how many times I get comments on my post. I'm not going to buy real estate. I don't want to clean toilets. What are you talking about? There's so many ways to remove yourself from that particular operation or that piece of the operation. And the passive investing is really the completely other way. You're writing a check and you're getting your distributions and you have nothing to do with the property. You're extremely separate from the operation. Yeah, so for passive investing, you have a multitude of options, but in here we included REITs. I'm sure many of you know about publicly traded REITs. You don't necessarily get the same tax advantages. They do provide regular dividends. I'm sorry, I gotta get it off this. So the pros of a REIT, like a publicly traded REIT, for example, You've got, regular dividends. It's pretty liquid, exposure to a variety of properties, which is really the biggest benefit I have come across with REITs, is that you have such a large portfolio of properties within the REIT, that you really have a lot of diversity from risk. So that's really helpful. And you got really great management, normally, or really highly educated management, because you can afford to pay them because you've got such a large volume of properties within the REIT. So those are really the pros of investing in a REIT. The cons is, the limited capital retention for growth. They have to distribute 90% of the funds, and you don't actually own the equity in the same way you do when you buy the property.
Like we said last week, I mean, a REIT, it's really a stock. That's the way you need to think of it. It is liquid, which is great. You can sell it, anytime you want to. You can't do that if you're an LP on a passive syndication. You can't just sell it overnight if you're a JV or own, a single family home or something like that. But it is real estate. And the biggest disadvantage is, the tax benefits are not there, which that's one of the main things that Lauren and I like about real estate too, the tax benefits.
So then private money lending. Private money lending can be great. I've done a little bit of private money lending. You just, essentially you're lending capital to investors. You've got an investor who, let's say, is, wants to buy and flip a $100,000 house. You can lend them the money. It's generally, you're putting a lien against a property. When we make sure, if you're ever interested or thinking about doing passive investing, or excuse me, in private money lending, in module 5, we have an actual note that you can use when you're private money lending, to make sure you have an agreement in place, and we can help you with that. But private money lending is a pretty secure way to invest in real estate. Typically, you're taking a lien on a property with it's already been discounted. So it's a nice way to be involved in real estate in a fairly safe way. And then real estate syndications, I think you guys know, Lindsay and I have been very involved in real estate syndications, both as general partners and limited partners, that they are, when you pool resources together to go buy a large property. For example, the last one we had was a 144-unit apartment building in Kansas City, something that we wouldn't have been able to buy on our own. We bought it for the group of investors bought it for about $10 million. Taylor's in that one. Shenko's in that one.
Junko's in that one.
Yep. And so for something like that particular one, the returns are about 15% annualized, 7% cash on cash. Those bigger properties can offer some great returns, better returns than you're typically going to get on a single family. So that's why a lot of people.
You don't have to do anything as an LP.
You don't have to do anything.
Great, and you get the tax benefits. Yeah.
Right.
Do the investments from all of the resources have to be equal, or some
No,
people?
They do not. For the syndications, there's usually a floor, a minimum. Generally, that is $50,000 in general for investments on the largest syndication. Some of the projects we've done, there's higher investments. Like one of them was $150,000 on this flex warehouse that we're building down in southeastern Pennsylvania, but in general, 50 tends to be about the floor. Some people come in with their 1031 exchanges from properties, and they come in with 300,000 or something. So it ranges, but that tends to be the. And anything that Lauren and I, our GPs, we always put our own money into in an LP position besides the GP share.
So the pros of a syndication is you can diversify. It truly is passive. You're not guaranteeing any loans, and you acquire properties larger than the ones you can buy on your own. And then cons is lack of control. They're illiquid, and I've gotten that question a lot in the middle of a hold period. They're not liquid. So you invest, you are holding until they sell that property. So a lot of people don't like that, but it is something.
That being said, you can be bought out. We've been in some deals where family emergency or something comes up and an LP really just wants to exit for personal reasons. I haven't had anywhere. It's the project itself, and other partners can buy you out if you need to. But the point of it is to keep it through the hold period to get your money, doubled or whatever it is, and the tax benefits. But yeah, again, it's not going to be an overnight like a REIT where you can just sell it at the click of a button.
I have a quick question.
Quick question.
Oh, sorry.
Yeah, go ahead.
Have you ever invested in a syndication where the return didn't happen as projected?
Not a syndication, but a joint venture. We're exiting right now. We have 2 LOIs that were accepted, and we're not going to lose money on it, but it's not getting what the person who did the initial underwriting and is the boots on the ground had sold to the small group that we're in. So it wasn't a syndication, but a small JV is not meeting the returns that we thought. But
The thing with a lot of these syndications is that, you know, for example, back in the Great Recession, right, when the worst real estate crisis in U.S. history, there were some syndications that got caught in that, but a lot of them just held long enough. So if you hold long enough, and that's for the general partner to decide. But if you know, for example, the one that we all invested in, or you know, we invested in together, Taylor, the expectation is a 5-year hold, 3 to 5 year hold. Let's say in 5 years we hit a Great Depression and everything's fine at the property, but if we sell it, we're not going to get our returns. They can hold it for longer, and they may, because they have a responsibility to investors to maximize the returns. So that's the benefit of investing with an operator that knows and is experienced. You know, these new operators where this is their first deal, that's tougher. But when you're investing with experienced operators, you know, they can generally spot when the best time will be to exit for the investors.
Because I feel like there's a real, I mean, I know we talked about it prior, but like for everyone, there's just so much, like the tax advantage, I feel like alone is so huge. And like, now that I learn more about it, even in like this, like the module, I'm like, oh, I feel like I want to because I feel like it's almost like an immediate advantage versus like a long term.
Yeah, it really is. And and that's why we spent so much time on the tax advantage, and we will continue to, because I love it when people tell me, oh, well, a 7% cash on cash return, I can get that from the stock market. I'm like, you can't get it tax free. So not from the stock market. So you got to use that. So it's great that those are clicking for you, and that's linking up, because that's a huge piece of it.
yeah, you can't do a refi and you can't leverage your money. I mean, we mentioned it last week. If you're buying a stock, you have to buy 100% of the stock, unlike a property where the bank is leveraging 75% while you then do the value adds. You do the refinance, get the money out tax free, still hold it, and the rest of the tax benefits on cost segregation and stuff. So,
Dear friend, do you have a question still?
Yeah, Lauren, quick question here. You know, about the syndication, there is a monthly rent, and how it breaks down, like annually, they pay out annually, or it's being pay out end of the term. Let's suppose if the syndication is for 5 years, how they really break down and pay out.
it all depends on the specific property. Like Lauren and I, we've done 3 Sharpline GP partnerships in the last year, October, December, and then in March of this year. The one that we closed on in October, there's no distributions for the first year, and that's per the underwriting because it was a brand new build. It was built in 2023 and everything was getting stabilized. The one that we closed on in December, it was a 6 months stabilization period until we got distributions, and this is the third, I think we just got the third distribution for that, the 40 unit. And then the 144 unit. So Sharpline, and for those ones that we're partners on in the GP, it's monthly distributions. Some of the other syndications that I'm on, they're quarterly distributions. And the ground up industrial warehouse that we're doing, that's also quarterly. So it depends on the deal. And sometimes they might give an extra distribution or more money than projected. Sometimes like the 110 unit that we have in South Carolina, we did a refi on one of the 5 buildings. So we held the distributions until it'll be September that we're giving it out. So in general, they're either monthly or quarterly. I think there's more syndications that tend to be quarterly than monthly.
Okay, on the investment of $50,000, there's an average distribution you guys are looking at. Let's suppose on 300,000, the one person 300,000 single family home, we're looking at one person $3,000, right? A monthly rent. When it comes to syndication of let's suppose I put down a syndication of $50,000, what is the maximum return in terms of quarterly or monthly, whatever we should need to look out when we do the numbers?
So we'll get into that much more in another module about the underwriting for multifamily and all that kind of stuff. But a general kind of like run-of-the-mill syndication, you're looking at between 6 to 8.5 cash on cash. So if you're investing, say, we'll just use $100,000 for a nice even. If you put $100,000 into that property, you can expect to get, and if it's an 8% pref cash on cash return, 8% a year. So you'll get $8,000 back per year on that, and then divided by 12. So, that's coming out to like less than $1,000 a month if they're doing the monthly distributions, plus the cost segregation that you're going to get back too. If you're, some of our deals are much higher than that, but that's kind of just an average one, an average equity multiplier. So that's how much money you're going to get back at the end of the whole hold period. So if you see EM equity multiplier of 2, again, just a nice round, and that's general between 1.5 to 2. On $100,000, you can expect, say they sell it 5 years, $200,000 total. That $200,000 total is going to be minus your initial investment, so the $100,000 minus the $8,000 that you've gotten per year, and if there was any refi, so it's the rest of the money to make up that EM of 2. Again, we'll get into that much more on charts and everything going forward. Those are just kind of basic numbers. And when you hear us or anybody say a pref return, a preferred return, it means that the limited partner passive investors get that minimum return before any general partner operator on the deal makes money. So say you didn't quite hit that pref and you thought it was going to be 8, but you only got 7%. All the LPs are getting that 7% before, and GPs basically aren't going to get paid, their returns on it. We want to make sure, or anybody that's a good operator is going to make sure that the limited partners are protected and paid first.
And do you guys happen to have any like a spreadsheet or Excel template for all of these breakdowns where we can put in the numbers? I don't know, might be I'm missing, might be already have in the portal somewhere.
So the software that we use, and most of the investors I know is called Synthesis at the Multifamily Deal Analyzer. We get no kickbacks, but in full transparency, one of our partners and operators, he actually created this. He's a crazy genius numbers guy, like my husband.
It is in the portal though, in several different places. You will see it. You'll see it.
That is a paid, I think it's a $300 like one-time fee. There are free ones too, because this one is like crazy. You can get it at waterfalls and all kinds of stuff. For the basic underwriting on single families and stuff that you guys will at least start doing, it's not like you're going to go be an operator on a 400 unit deal like right off the bat and raise $10 million. You wouldn't have to use Synthesis right away. But all the underwriting that you see with Michael and stuff, it will be that Excel file. The numbers aren't going to change though by using free calculators online. It's still going to be
okay. That's the software you're talking about for all the calculations and break down all the analysis. Let's suppose you was talking about create an Excel where you can keep all your data, right? Do you already have that template?
Yeah. You mean for like when we're talking about to contact banks and brokers and stuff?
Well,
the names
yeah. Do you have all that template with you guys where you can share with us?
Yeah,
like
we can
any
definitely
action,
share. Yeah, I
yeah,
can
action plan. If you have it, that should be great. So we can follow the same pattern, for all of us.
Absolutely. Yep, we can definitely do that. Yep.
Yeah, any template that should be great,
Yeah,
so
absolutely.
we should be on the same page every time.
Yeah, sure.
So I want to share just on a high level too when it comes to these. It's a lot of people sitting on capital who are in capital preservation mode, let's say. They use syndications or real estate like this to reliably double their money every 5 years. And there's a book in section 5, module 5, which is called The Perfect Investment. And I recommended it to all of you. But it really is interesting if you are speaking to family offices ever, if you're familiar, family offices, a lot of very wealthy people have family offices that manage their money essentially and manage their affairs. And a lot of them like real estate syndications for a reliable way to double their money every 5 years. It's not high risk, generally speaking. I mean, every investment has a risk. I'm not saying that every investment, stock, real estate, everything, but this type of real estate has been used to reliably double money since the 1940s. I mean, they built Los Angeles and New York on real estate syndications. So this is when I learned about these, I was like, my mind was blown. I'm like, what was my grandfather doing in New York in the 40s? He was there, but he wasn't in these circles. And I think that's what's so interesting about now, because historic real estate, as I said, real estate syndications have been around since the 1940s, 50s, but it was kept amongst people who invested together. And now with the advent of the internet and the more democratization of information, a lot more people have become aware of this type of investing. And a lot more people who aren't have previously weren't in those very small social circles now have access to these types of investments. So it's very interesting. I've spoken to some family office representatives that are they want to go in on properties like this, and it's not going to be the 10x that some early stage startup might give you, but it will certainly be a more reliable way to compound wealth.
I want to just throw one thing in there. I actually did not personally read the Perfect Investment book, so I'll have to read that or listen to the audiobook. But just to show the power of compounding and on a 5-year term, if you're going to invest, say you don't want to, fix toilets, like you say, you don't want to be active, you just want to, focus on passive investing. That was one of the things for you guys to start thinking about which way you might want to go this week. But after year 5, you don't have to inject any more initial capital. So if you're investing $50,000 in year 1, then $50,000 in year 2, $50,000 in year 3, 4, and 5. By year 5, if your hold period was 5 years, you're going to, and your EM was 2, that $50,000 became $100,000. Now at year 6, you can re-inject $50,000 again. It's not new money. You've already done it. And do whatever you want with the $50,000 you made, or you can now inject the whole $100,000. Then on N plus on year 6, you're getting the payback from the one that you did on year 2, because now that's 5 years. And you keep doing that. So you're just ballooning up your money. And that's what Michael and I have done. We have not taken literally $1 for ourselves. And like, I think I mentioned last week, Michael jokes how he works for free. He has never gotten a paycheck. It's because all the money we're making, we keep re-injecting this on this conveyor belt of real estate. So once you get to year 5, again, you're not injecting, or you don't have to inject any more of your own money. It's just duplicating itself for you.
Can
Lindsay,
you,
but
sorry,
yeah, go ahead.
clarify about this syndication versus crowdfunding? I had some kind of crowdfunding project. Some of the not going too well end up like default. So what's the difference?
So crowdfunding is more accessible to the average person, and it's a much smaller investment amount in general. Crowdfunding, you can put, like, depending on the deal, $50, $1,000 instead of these minimums that Lauren and I tend to do with these general partnerships, where it's more like $50,000 or something. So it's much more accessible on a smaller scale for people. And a lot of the crowdfunding, you don't have to be an accredited investor. There's tons of syndications where you don't have to be accredited or not, and we'll get into that too. But it's, in general, crowdfunding is lower amounts and more accessible to the average person.
Okay, but similar concept, like pooling.
Similar concept. Yep.
Okay.
Mm-hmm.
All right.
Yep. I know Brandon Turner of Bigger Pockets, he does crowdfunding for some of his deals. Brandon Turner's great. I know him, but there's many different crowdfunding things. You can literally type in real estate crowdfunding. You'll get a ton of things that come up. I personally don't invest in crowdfunding. I haven't put any of my money into that.
I haven't either.
Lauren, when you was talking, you mentioned about home office. What do you mean by family office? I think that's what you said, right? Family
Yes.
office.
Yes,
What
so
do you
family
mean by family
offices,
office?
it's for generally families that have they're considered ultra high net worth, so $30 million and plus is usually what that threshold is. Then a lot of them will form family offices, and those are people who are made to essentially manage their money and manage their affairs. So it's pretty. So when you hear people refer to a family office, oh, this family office came into this property with $2 million. Generally, they've got, again, the family has a net worth of 30 million or more. And,
okay.
And then they enlist a group of people to help them manage their affairs.
Okay. And one more question, Lindsay, when you was talking about, let's suppose if you initially put down $50,000 investment and you just keep circling it, keep reinvesting that money rather than just taking out the profit. Let's suppose if someone has only the single source of income, if someone just have a single job, what is the best strategy for that specific person if he or she don't want to take out money for profit?
You don't have to. I mean, if you're remember, so if the EM is 2, you injected that initial $50,000, then you've made $50,000 back. My advice is to keep that initial 50 seed money and keep reusing it, but then you can start to pay yourself. And that's the whole idea of this passive income to become financially free. You want your passive income to pay your lifestyle. So if you start on year 6, 7, 8, 9, 10, getting 50,000 and 100,000 back a year, that's great. That's going to replace most people's salaries. So yeah, you can and absolutely do that. And it's going to come to a point where, you know, ideally you're making enough money where you're like, I have enough. I don't need to, you know, keep re-injecting. Now, a lot of people, when you have your CPAs involved, they'll say, well, just for tax benefits, you should still put it in and, you know, buy another property or something. But yeah, you absolutely can take the profits that you made on that and use it to pay for your lifestyle. That is the whole point of being financially free.
But do you think with all these money we make through the real estate, you know, do we get any tax benefit on W-2?
So you, on the W-2, you do not, unless you're real estate professional status. So that means you are doing that. There's very specific laws for this. So you have to be working at least 750 hours a year actively in real estate. And actively doesn't mean fixing toilets and stuff like that. It could be, you know, underwriting and doing all that kind of stuff, but it has to be at least 750 hours, and you can't have any other job that you're working more. So for myself as a physician, I would get audited because they'd be like, we know you're working as a doctor a lot. There's no way you're working more as a real estate professional, even though I feel like I am some days. But my husband that is his job. So because we are married and he has the reps status, that can come off of my W-2. So it's an extra loophole of real estate, just like Lauren
Module
and her husband.
6.4, if you want to skip ahead
Yep.
and learn about that, module 6.4 is all about real estate professional status. There is an option for 6.4. There is an option for W-2 employees for short-term rentals, which I talk about in module 6.4 as well. So you know, certainly watch that, because if you are W-2 and so is your wife, or she's not involved, that is an option for W-2. But bear in mind, if you continue your passive income, if you continue to invest in this way, whether you're W-2 or not, that is tax advantage. So it may not impact your W-2 income, but it will impact your passive income. So keep that in mind.
And for that purposes, specifically to keep your real estate status, do you need to keep a log for 720 hours? What you was mentioning about it. So in case we need to give a proof, they can ask anytime.
I would very much suggest doing that. Michael has like a little notebook. I have to remind him some days, but yeah, it's just put the date, you know, went to this building, did this. Sometimes receipts even, you know, help you if we go out to lunch or something with people. Always keep your receipts, just keep a log. Bookkeeping just from the beginning, just get everything, you know, get into good habits from the start.
And do you guys, both of you guys, do you use any professional bookkeeping, or that's what you are mastering?
Michael uses, he keeps track of all that. He uses QuickBooks. There are other things out there, Lauren. I'm not sure what you use. QuickBooks tends to be a very
I actually use QuickBooks as well, but Baselane is also a new one that offers an ability to do that, and also I also, in one of the modules in the resource section, I have a profit and loss Excel sheet that, you know, if you only have a couple of single family rentals, you don't necessarily need to enlist software. I mean, you're welcome to, obviously, but it's not something you want. For my single families, and to be, you know, totally transparent, I just keep it on, I only have 3, and I keep it on a spreadsheet, which I included the template in one of the modules.
Thank you. Thanks a lot.
Any other questions?
Not right now.
Okay.
I'm good.
All right, then we'll move on to active investing. There's plenty of people that say there's no way I'd ever invest with anyone else. I have a number of people in my life that only want to buy their own. They'll rather buy one property per year and maintain complete control than ever invest, you know, passively with someone. So you can do both. You can do one or the other, but this particular lesson is on active investing. And module 3 and module 4 are also primarily focused on active investing. So it involves direct involvement in the management and decision making. So it requires a proactive management approach, real estate know-how, hands-on control in the acquisition, the management, renovation, the lending, the sale, all of it. And so we want to equip you, and we are going to equip you throughout this course to be able to do all of these things if you want to have an active role in your real estate.
And active investing doesn't mean you are doing all of this by yourself. You can be with a partner and just you and somebody else, a partnership buying something, and each of you have your own roles. You can do the joint ventures, you know, like Lauren and I do as well. And everybody has their own like little specific role. For one of our JVs, we've never stepped foot on the property physically at all, but Michael is very hands-on with doing some of the SEO, SEM website. He designed the website and that kind of stuff, dealing with tenants that way virtually. So you don't have to be perfect at all of this. You can still find your who, not how, and have a good partnership and still be active.
And here we go through the active strategies. Again, this was in the module, but we've talked about, you know, there's different types of investors. I have invested in more turnkey type projects or type properties. Lindsay's been very hands-on with renovation, and there's furnished rentals. So there's the, you know, the turnkey property. It's newer, and we're going to go through some of that at the case study at the end of this, at the end of the lesson today, or at the end of this presentation. Easy, normally fewer surprisers if it's turnkey. Cons is you have to come up with 20 to 25% every time you want to buy a new property.
Okay,
then,
I have one more question. When you guys talk about hands-on renovation, it mean the property should be the same place where we live at, probably, you know? If
Doesn't
I'm
have to be.
not necessarily
Nope. There's a really good book called The Hands-Off Investor.
the hands-off.
The Hands-Off Investor. And there's the Long Distance Investor too. Both of those are good books. I've read both of them. So that doesn't mean you're the one doing it. You can if you want to. Again, I know people that buy on their own. They do their own renovations. Michael's done our own renovations, but you can buy from afar and you can manage you can call the contractor. The contractor's there doing the renovations. You don't have to be there. You don't have to be boots on the ground and live there. So that doesn't necessarily mean that it has to be where you're living to still be renovation.
Taylor,
And how do you do
rental in Kansas City?
Sorry, say it again.
Don't you have a rental in Kansas City?
Yes.
Yeah, so you're and she's based in Los Angeles, and I have a rental. I have rentals in Tennessee and Florida, and I'm technically the active investor in them, and I'm not local to them. I'm in California.
Then a quick question: when you say hands-on renovations, let's suppose Lindsay, you're very hands-on, but if you're not there physically to look what the contractors are doing, how do you manage from so far from
So
that far?
we
You know.
do check-ins on some of the properties. So we'll call and have a live, like not Zoom, but FaceTime with the contractors and walk around. So we're checking in on them daily to make sure that things are getting done, send pictures, timestamps of things. So hands-on, again, it doesn't mean you physically have to be there to be managing the project, but you still have very active communication with the person that is physically hands-on there.
And since as an investor you have properties all over, you know, have you ever got a chance to visit each of your property what you have invested in, or it's not necessary? It's not necessary.
It's not necessary. Like I just mentioned, we have never physically been to the 8-unit JV that we have in Indianapolis. Michael's still active on it, but we have never physically been there. And this was a whole renovation project. All 8 units were renovated. One of the JV partners is there as a boots on the ground. Another one, Michael went one time. I've never been to them. Some of them, like the 8-unit we're doing right now, Michael's there like every single day. He's very hands-on with that one. So this is one of the things I love about real estate. As long as you have very good partners, you can split this pie so many different ways, and each project can be very, very different.
And for me, when I bought my first rental in Florida, I hired a property manager who had an in-house contracting team and used their contractors, and they communicated with me. It took 3 weeks to get the renovation done. They communicated with me the whole time, and then they found a renter. And so, if you find a great property manager, if that's what you want, a lot of them have in-house contracting teams.
And a lot of people do. They don't want to be the ones dealing with the tenant, so they will they will pay a property manager up front. So it is their job to then be the ones that are more hands-on and give you updates at whatever time frame that you guys agree upon.
I have a question.
You know,
Oh,
yeah,
go ahead.
go ahead. Go ahead. You go ahead.
Okay. So when you started like investing outside of state, um, did you start looking for like a broker or agent in that area first and then kind of like expand like more network from there? Like when you actually like a beginner, full beginner, or you
Myself
were
personally, we started looking for partners that we trusted who were looking for deals locally. You don't have to do that. You can do it on your own. Again, those two books that I mentioned, it's how it walks you through that in more detail. But yes, in that case, if you don't know anyone in the area you want to invest, then you look for brokers and you start talking on the phone with brokers, telling them your buying criteria, what you want. You start calling local contractors. You talk to the people that live there, work there, like your broker, and say, who would you recommend? You start calling different property management companies, and or you say to the realtor, who's a good property manager there? And then the property managers, they're going to know who the good contractors are. So you start talking to people and getting referrals if you don't know anyone in that area.
So when I bought
But then,
my first rental in Florida, I wanted an investor-friendly agent. And so I called over, I got referred through kind of poking around through meetup.com. I got referred to an agent over there that only worked with investors, still only works with investors. He doesn't do any retail sales. Most of his investors buy property over FaceTime. He doesn't even, so he was so familiar, and he has in-house property management, he himself.
So
So
that's a big point. The investor friendly, ideally you'd like to get agents who invest themselves too, because then they have their own contacts too, right? And they have their own proven proof of concept.
so actually I contacted through Bigger Pocket. There's like a
That
site that
that's
you
I
can.
was just yep, that's a great
So
one.
and then on the list it says like investor friendly, and then like there's a people on the profile it says like I would like to teach or whatever, like, and then I kind of pick a couple and then like email them, and then some of them kind of email me back. So I think that's good
Yep,
start.
Bigger Pockets is a great free resource. You don't have to get the pro membership. There's tons of you can get everything you need for free there, but that's a great resource. Bigger Pockets, there are investors everywhere on that site. So you look at the market that you're in, so you can start that way, or start Googling too and just calling around. Yeah.
Thank you.
Yeah, from what I've read, I think I guess before you start looking into real estate or buying, really just build up your whole team, like a good accountant, like a property manager, have that all just lined up that way when it's
Yep.
time to like do your due diligence.
Yep.
You're on like a time constraint, so that way you're not looking for last minute,
Yep.
you know, people that
It's
might ruin
exactly right.
your investment.
It takes some time to build up those connections, but if you make it a point to take 5 minutes once a week to call one new broker or check in with that broker that you talked to last week, it's your relationships are going to build, and you'll get that database quicker than you think.
bear in mind, Lindsay and I have a pretty extensive network as well.
Yes.
So if any of you have this particular area that you're looking in, it's highly likely that we know someone we can connect you to. Bigger Pockets obviously is very
sure.
cool, but she and I personally, and oftentimes the warm introductions are fruitful. So please, that's why we're here. Reach out.
Now, now tell me, are you guys, since you've been investing for so long, are you pretty much restricted yourself to the certain markets where you have a very high yield, and
No.
you keep experimenting as well?
I have partnerships and markets that I am more comfortable with, and the proof of concept is there. We know we're making money. However, markets are changing all the time. What is not a good market today could definitely turn into one in a year. So we keep our eyes open, and we keep an open mind for everything. And you're always going to be meeting new people too. So just as a black and white answer, no, I'm not restricted to certain markets now. If the deal makes sense and the partnership is there, I'll invest anywhere.
Okay, and as a totally newbie, what do you suggest? That's the market you always start with, where you have great chance of breaking into without any any danger or something. That's the best market to start with,
Yeah, there's
like
definitely not a
Pennsylvania or Kansas or something?
Not a single answer to that, because any investment has its own inherent risks. And even if it's a great investment that you buy, if it's not managed right, it's going to be a poor investment, right? So there's
I
not
can
a,
tell you my interests are Kansas City and Nashville,
Kansas.
south of Nashville, Middle Tennessee. I mean, those are two
Because
places that I'm pretty bullish on.
because talking to specifically Lauren, I'm pretty sure Texas is not good, because I do have houses, and that's what I was thinking, to sell it out and move to somewhere else, where I will talk to you about it later, personally.
We need to
Where is it
1031
good?
that.
I can't
Especially
wait to
sorry?
talk to
property
you
that's
about
not getting
Tennessee,
sold.
Lauren. I can't
Yeah,
wait to talk to you
Liza,
about
today
Tennessee.
we're looking at a Tennessee neighborhood that I want to show you. So
Okay, so
that's
yeah,
what we're doing
I'm
at the end of
there
this.
every month, so I can't
And,
wait.
and
Yeah.
you said Tennessee and Kansas you talk about?
Kansas, yeah, that's where Lindsay and I have quite a bit in the Kansas City metro area. So we really like that market. And then for me, Middle Tennessee, Nashville, south to the Alabama border, I'm pretty bullish on. And again,
and
I'm
for
not.
Michael and I personally, like, we still are very active and in Pennsylvania. So we're constantly looking here because that's where we live, and that's where we're very, very active in personally too. But
Perfect. We probably end up moving to Pennsylvania, looks like.
you better like snow. The winters, terrifying.
That's a because I have a lot of family in Texas. What they're doing is they have a lot of multi-family houses. Let's suppose, especially in Dallas and Houston, and they always have a same crew who manages their single family, and it's really easy for them to manage it, to keep the cost low. That's what I learned from them. But they're not they have like 5 and 10 multi-family houses, and they're managing for a very long time, making good, passive income. And they think that's the best strategy. But I'm learning something new from you guys, since you're an investor like state-wise.
And
Yeah,
it
I mean,
sounds like
it's
they
also,
have their teams in place, which is good. And that takes time.
yeah, and they've had them for a while. They've owned them for a while. The times have changed. If we were all buying 10, 15 years ago, it's a very different world than it is today. So maybe that's when they bought and it's cash flowing great. But if you try to come into that market now, the cash flow is not there. So you got it. And that's another
Yeah,
reason why.
because
Okay.
yeah, for me, like for $400,000, when I look at their properties on $400,000 property, they are not getting 1% back. That the max is they're making around 3 grand on 400,000 property, and that's what when you was talking last time, you says that's the minimum standard. Look for 1% is the best way, and that's what I'm keeping in my mind. When I look for a property, at least 1% is a great, if 300,000 property, at least you got 3,000 back every month, on a cash flow side.
And if it's
Yeah.
not doing that, move the money. And I mean, but it's about how active you want to be. Plenty of people don't have the interest, and they'll just buy one property per year till they're
But
70 and
but
fine. But there's a lot
but
more your
on the
money
other
can do.
but on the other side, let's suppose if I'm investing, let's suppose Pennsylvania or Kansas, and I'm making 1%, but on the other hand, I'm paying to a management company and some other. Whereas these people who are investing in their own state and city where they're living, they're cutting the cost, when they're doing all the self managing everything, right?
Yep.
Yeah, so
But
you
you're
have to see the
trading
numbers.
some of your time for that too. Like some of the
Yeah,
property, like we're not paying a property manager, but Michael's there, he's doing that work. So it's all a trade-off, and
saving
how
all that
active you
money.
want
Yeah,
to be. Yeah.
I think if it's like a
it's all
multi-unit, just better to hire a professional
Oh
property
yeah,
manager to
for
do
sure.
it.
Yeah.
It's a
And there's
clean job and it's sound, yeah.
the scale component too. So once you start getting into the bigger multifamily, so a single family, a property manager might take 10%, but when you get to, it doesn't have to be, say, I don't know, 20 units even, or 50 units, instead of 10% per unit, you're down to like 2 to 3% a unit, because it's just that economies of scale. So the property management isn't taking as much per unit because they're just there and that's what they're managing. So the price goes down too.
And something to consider too, it's, let's say that you really want the active, once you can get that scale on your own, in the sense of, if you identify that you love Tucson, Arizona, And you're like, that's my market. You can go and buy a fourplex and a fiveplex and a tenplex and then just have one person that you hire, maybe that is your manager, and you pay them a flat fee. I mean, I have a friend who does that, and they're because he's got the scale now. He has about 75 units in Tucson. He can pay one person a flat fee, and there's no percentage taken out. So there's lots of ways to make it work.
I would say, even if you're going to manage the property yourself, and what we do when we underwrite, even if we know like the 16 unit we're trying to get it under contract, we know Michael's going to be managing it, but in the underwriting, we're still putting 10% property management, because maybe we will end up moving in a couple of years. I don't know, and we want to make sure that this is what we would be paying. So we still underwrite for that, even if we know we're managing it. And I would suggest that you guys do the same. You want to have buffers as much as you can in everything.
Any other questions on this one?
Have you guys ever thought of establishing your own management company?
So
Since you own a lot of properties?
we do have it with Sharpline and these syndications we have in Kansas City. They are self-managed properties. It's
Okay.
Sharpline, yeah, management, yeah.
That they have 700 units in the area, so they can do that. And
That's you own that management company?
No, we're
But
part of
there's
equity.
we have a regional property manager, property managers for each company. I mean, it's really a big property management company, and you don't have to start that way. You start to get 20 plus, you can start your own property management company, and you can manage for other investors too. I know one guy in Pittsburgh that just recently started one. He's doing his own with his management company, and he's managing some other local investors. So it's something you can do.
Back in my college time, I had a class fellow, and her father used to own a lot of apartment complex in Texas. And what he did, he had her own insurance company and the security company who take care of her all the apartment, all the properties for the insurance. If you Google it, American Risk Insurance, he still have it. It's a very good insurance company. Even I used to use for my properties, until the last year. He owned the insurance company and the security company who gave all the security and insurance to all the properties. Not only that, they also give all the for public as well.
They keep everything.
After they was
insurance company.
Yeah, after he was very successful, he ventured into insurance and security as well. Probably a management company. That's what, because I met with her father a couple of times, went to their home, and I figured probably he have a management company as well, because he have a lot of apartment complexes in investments,
All right. And then the last thing for the active investing is furnished rentals. If you're dual W-2 employees, go to module 6.4 if you just can't wait. We talk about real estate professional status, and there is a loophole for short-term rentals if everyone if both people in the family are W-2 employees. And then most people think buying is investing, but they're wrong. It doesn't make you an investor to buy something any more than buying groceries makes you a chef. And I really love that quote.
And that's what, even I talk to some of my in my family, the older retired folks, I tell them not buying properties makes you an investor. They bought it, they hold it for 15, 20 years, 10 properties, but there's a whole different mindset being an investor,
Yeah, I mean, we like to target what we call these mom and pop owners. They're not treating it as a business. They've bought it, but they're not cash flowing. They're not managing it like a business. So we actually like to kind of buy from those type of investors. But yeah, that's a perfect example. They're not making money, or they're not doing it right, even though they own the property.
Yes, I had someone at my house this week who said, "Oh, we've had a rental for 20 years. We never think about it." And I'm like, "Well, you should start thinking about it, because you've got a lot of equity sitting there that's doing nothing for you." I mean, you could probably think, well, that Liza was like, "Well, we'll talk on Saturday. I'm really excited about our conversation." But I mean, start thinking about it. You can get more intentional and move that money into something that's going to pay you a lot more. So again, we're obviously, Lindsay and I are pretty intentional with our choices here.
Lauren, I figured out the reason people don't want to, because people are so scared first thing to learn something new, to add, And the second thing, when you learn something new, you are challenging your old style, living style, way of thoughts, and more older folks do not want to go into that specific adventure. They just want an easy, reliable money. If they're making 10, 15 grand from all these properties, they think they're good enough.
That's the comfort zone. People don't like change.
They don't want to come. Yeah,
Yeah.
they like to be in their comfort zone.
Yeah, the comfort zone is what is it? Good is the enemy of great. I love that quote because it's so true. And Luigi, my husband and I are constantly challenging each other in that because things are good. They can always be. That tends to be the problem because then you aren't incentivized necessarily to make it great.
Yep.
So we constantly push each other. But okay, so I'm sorry about that. So passive investor, if you want to get into passive investing, first steps, I mean, the most important thing if you're passive investing is networking. Who you're investing with, the operator you're investing with is everything. And both Lindsay and I can speak to times where we made some mistakes in that. And so we've become much more savvy in terms of how to choose operators. So, if you're ever thinking about investing passively, we have a lot to share. And module 5 goes into vetting, and we have an entire lesson on vetting the operator. So if it's something you want to do, and networking and vetting your operators is the number one.
No.
And to go back to what Zan was saying about crowdfunding, that there's an issue with the operator. People are losing and they're not performing. It means the operator is not vetted. I don't say vetted properly, but the operator not good enough. And so that's just a misstep in terms of who you're investing with.
In terms of networking, I was reading I think it was in module 2, you was talking about set a one-to-one call with all your peers in the group, right? Now, because I was thinking to start doing it, how do you suggest like sending a Teams invite for a 15, 20 minutes call one-to-one so we can get to know each other and learn from each other?
So you guys all have each other's contact information. So start, reaching, email, text each other. Lauren and I, we use Zoom all the time. So make a Zoom account if you guys are all here, right? So you Zoom. So make a Zoom account and then you can set up and send each other, the links for it doesn't have to be long, but when I do a networking call, it's usually 30 minutes. That's what I set it up
30
for.
minutes. Okay.
Yeah.
Okay. Perfect. Got it.
And then
because I'm going to start sending emails, I'm going to start one by one, whoever have a time for 15, 20 minutes,
Yep.
So but I will be in middle, I was traveling a lot here, but I will definitely, because right now it's 4 a.m. my time, I'm trying to make sure we are the same time slot, so I can work with all of them. Thank you.
And if you want to invest actively, the first steps are choosing your market. I mean, before you can build a team and identify lenders, and you've got to choose the market. And we have entire sections on that coming up. But, landlord friendly, population growth, business friendly, job diversification, schools crime. And we're going to get into that when we look right now. Into the case study I'm going to do with you guys. But it's really, all of those factors are important. And then you build your team, agents, property managers, contractors, lenders. But I will tell you, the majority of my contacts all stemmed from finding a great agent, a great investor-friendly agent in each of my markets. So once I found a great investor-friendly agent who knew exactly what I was looking for as an investor, he had property management, he had contractors, and he had a list of lenders. So start there, start with the agent. And if you're not sure and you've identified a market, reach out to Lindsay and I. Like I said, we know people everywhere. So like if we could find you a great investor agent.
We're definitely going to use your resources, Thank you.
That's why you guys are here.
That's why we're here.
Yeah, learning, that's why, that's the good thing, because you guys also reading the books, and that's the purpose of reading a book, to learning from other people experience and knowledge, rather than investing your time and your money into it,
Mm-hmm.
Yeah.
Learn, that's exactly the reason to get a mentor, right? Like, don't reinvent the wheel. Take the knowledge that other people ahead of you have gathered and use that as your stepping stones.
I lost, I'll say $10,000 between 3 different escrows that I fell out of, and traveling and legal fees and inspections. that I could have just gotten a mentor and saved me a lot of that. But I didn't know, and I kind of just
Talk,
jumped
talk
in
about
because of my
mistakes in the
personality.
beginning. Yeah.
You know, but but Lauren, the good thing about with all the drag you had because of that real estate thing, it gives you a lot of confidence, self-confidence, because now you know what you're looking into it. What really happens just by reading the book, you still lack the confidence, believe me or not, because I have read a lot of stuff, because once you go through practical step, because that's the drag, that drags gives you a lot of, it opens the new horizon in front of you, and you know what you're doing, your skills, you basically unleash your potential, the new potential you find out in yourself. That's what happens.
Yes, no, you're absolutely right.
And that's what I have experienced with myself. Reading books is definitely a good thing, but that's drag. What the drag of the time gives you, it unleash the potential what you don't know about yourself.
Oh yeah, I read 2 books. I'm like, I can buy a 30-unit apartment building. I got this. And I didn't have it 2012 later. So yes, you're
and
exactly
and
right.
I was and I was reading about Michael, because Lindsay and Michael bought their first investment in a D class, right? D class neighborhood or something.
Oh, yeah.
But
Shenandoah,
with
Pennsylvania.
yeah, Pennsylvania, and with that experience I was reading, they learn a lot. They learn a lot.
We learned a lot of sweat equity lessons, and we
Yeah.
lost a lot of money and time into that. But I would I go back and do it again in the moment? I definitely would have said yes, screw this. But we learned a lot from it. So again,
And
learn
what
from our mistakes.
and what you guys did it when I was reading Michael, just I think that's what you read a book, and you said, okay, I read a book, I know everything, I'm
Yeah.
gonna buy this property now.
Yeah,
And that's what
ignorance is
happened with
bliss.
you.
Ignorance is bliss. Yeah.
Yeah. But I'm pretty sure that experience, that experience give you a whole different dimension, how to look all these things now.
Yeah. Michael did not know anything about rehabs at the beginning, but now when we go to look at properties and we're like, oh, we can see there was fire damage there, and that's asbestos and that, and some of these sellers, they're like, oh shit, like you can see them look, they're like, all right, they know what they're talking about. Like, I'm not gonna be able to call this for what I wanted to them.
And you cannot replace that experience with
No,
books,
you can't.
because I have renovated my own houses, I was physically present there, and I learned a lot, because before I hire a contractor, I Google it, I watch videos, and when they start giving me an estimate, I know what I'm looking into, doing my fence, doing my floor, doing my roof, and everything. I knew I was what I'm looking into, just doing that 2 specific projects. It gave me a lot of knowledge. It was
Yes.
through
I mean, if you're
YouTube, and then I did it, and it gives me a lot of confidence. I know what I'm looking into.
No, it definitely does, especially if you're going to be an active investor. Now, there's a lot of people I work with at the hospital, they see the pictures before, they're like, yeah, I don't want anything to do with that. So they just want to be passive. So, I mean, that's one of the main action items here that we wanted you guys to think about this week, start thinking about. And it could change, as you're going through these modules and everything, but do you want to be passive? Do you want to be active? Only one of each? Do you want to do a blend? Alone, with partners? So start thinking about that. And I'd like to hear just from each of you, it doesn't have to be long, just even 30 seconds to a minute. I'm just going by my screen up here. So Junko, what are you thinking so far?
Yes, so I would like
That's
to do
yeah, go ahead.
oh, so I would like to do both. So since I was able to participate in a like syndication deal, um, that was like just kind of like an eye-opening experience for me. And my goal is I think every year somehow, like I want to start investing as an LP or actively. Like I want to do like once a year. Also like in the next 6 months or like I'd like to buy some property, like started to really actually looking. And like I have been listening this podcast and stuff, everybody, every single person said you really have to educate yourself, you really have to network, networking and put yourself in a people actually, that you can learn and mentorship. And then the last thing is just really like fear, like overcome with the fear to and that's I think something that like I really need a mentorship that I'm really glad that I'm in this group So yes, I like to do both. And my goal is like once a year as an LP or active that I actually wants to initiate. Yes.
You can definitely do it. It's not even a goal. You're going to do it.
Yes.
Jose, what about you?
You're muted.
Oh, you're still on mute.
There you go. Sorry.
There you go. There you go.
I definitely want to be an active, and pretty much find maybe two other investors to help fund the multi-unit property. Definitely looking into Pennsylvania and Tennessee. Definitely, it's all about the location and the marketplace. So, looking to do that. I just feel knowing my personality, I like to be very involved, and I make the time to make sure things get done the right way. So I like to be kind of more involved with what's going on and have control of the situation, but definitely Tennessee and Pennsylvania is a little far from me, but I can definitely travel there easily on the weekends and just book a flight out there. But definitely build a team, like a very good property manager to help have the eyes on the property while I'm not around.
Well,
Yeah,
Jose,
it
we
sounds
know
like
a lot of people in Tennessee. So once you hone in on the market, I mean, we can connect you with the right
Yeah.
people.
So definitely looking to do at least a minimum of 4 unit, but I would like a 10 unit. But I'm still learning. I already read through 2 books, so
awesome. Great
still
job.
reading, still learning. Yeah.
Awesome.
You know,
I was
Jose
gonna say you're
talk
next
about
on my screen, Irfan.
Jose talk about know yourself is a very good thing, because you always, when you know yourself, you always play on your strong points. That's very important thing whenever you're going into any venture business. Knowing yourself, what's your strong points, really help you build yourself.
Yeah, absolutely. Absolutely. Thank
So
you.
what about you, Irfan? What are you thinking?
No, I like to be a surgeon, who knows in and out of everything. Because I like to learn it and do it by myself. That's the only way I can grow, and definitely active, and but start small to educate myself. I'm always big on listening, so I can learn from you guys. Just listen, because when you listen, you understand other person mindset a lot. What he or she's coming from, what he tries to deliver you. It helps you a lot. And as Jose just said it, know yourself, know your strong points, and you always have to play on your strong
Yeah.
points. If you are like you always talk about Michael, he's very good in numbers. That's a strong point. And I can just talking to you, looking at you, you're very good in networking. That's your strong point. And it makes you a very great team to be
Yeah.
successful in this property business. And that's, you already know what's your strong points, and you're working, making as a great team to be a successful. That's what you need to know, what my strong points are, and on my strong point, that's what I'm going to build it. If you try to lead on Michael in the number game, you're going to make things more confusing.
I'm not reinventing the wheel. Yeah, he's
Yeah,
got.
yeah. And if he's trying to lead you on in a networking, talking people, that he's going to destroy everything. Just
So
play
it's
on your
funny you
strong
say
point.
that. There's been so many times where we're doing like a podcast or talking, and we actually have we have an understanding that if he's talking too much or he starts getting derailed, I'll like kick him under the table, and he knows to like wrap it up because this has happened many times.
Yeah,
But it's
because
like,
you're a
yeah,
people person. You're a
yep,
people person. You're a networking person. You know my strong point. That's
yep,
my domain. Let me play it. I know how to handle all these people. How to
definitely.
sell it.
You too, active investor all the way for you. What about you, Liza?
Yeah.
I am definitely passive, at least to start, definitely. I know, I'm surprised so many actives. I was like, thought, at least to start finding the right partners. I just know what, I'm, first of all, so much to learn. I mean, I think I'm like 20 steps behind everyone here in terms of, so have the podcast going, the audiobooks, all of that. was actually excited when I listened to a few podcasts and I was like, oh, I know what they're saying. I know the terminology. So just in like the past week and a half and watching these modules, but definitely passive to start with, you know, my day job, family life. I feel that's where I can learn. I think eventually a combination of both seems like it, you know, because I could, it seems like fun and exciting and, you know, that ability to control that comes with active, but I think I have a lot to learn and I would probably use passive
And
to
being
learn and
passive
get
is
to make
still
them.
a great way to learn. You're still going to be getting the
Yep.
newsletters. Some teams have what they call active LPs. Like you don't have to do anything, but you can still get invited to the monthly calls to hear, or we do a lot more than monthly calls, but with the operators to still continue learning too.
Yeah, one of the podcasts I was listening to, one woman she was a passive investor, and now she said she's active and she's flipping, and she's like, I never got into never thought of flipping, but she said flipping's kind of passive for her now because of all the years of experience. So I guess it depends how you look at it. She's got a contractor that's like, you know, that also invests himself. Like you always say, it's the first thing to ask people, like, do you invest yourself, whether it's a broker or whoever, property manager. So she has all of these, her team so turnkey that she's active and flipping, but to her it's almost passive now because of the experience, the knowledge and everything that she's built. So
That's such a good point. I mean, she's really managing the manager of the managers, right? Like she's
Yeah.
not doing anything active because her teams are so drilled in. So yeah, that's an interesting way to think about it. I like that.
Liza, one of my 36 unit investments, they have Monday morning asset management calls and I sit in on them even though I'm passive. So it's a great way to learn. So I love that. I think
And you know one thing with a lot of reading and podcasts, what really happens, a lot of people who are just a beginner, you know, analysis paralysis, you know, and you know, if you're not into a business, that's what, you know, that's what I keep telling myself, you know, all the time when I'm trying to do something new, biased towards the action execution, you know. So I try to keep myself very optimistic, you know. I try to educate myself, but I make sure I'm not into analysis paralysis. But a lot of reading, a lot of podcasting, listening, and all the time. That's what happens. End of the day, if you don't have an experience, it goes both way, you know.
What about you, Taylor?
I think Lauren got me into the syndication, so the passive part, but I think that's what I'm comfortable with because I just feel like the benefits are great, but I want to, like, I keep looking on Zillow and I'm like, this is the rents are already exceeding, and I just need to do it. Like I need to become active. Like that is my goal. I don't know. I'm just fearful, but that's why I'm here to learn and to just get confident. We have the house in Missouri, but we bought it through the Bigger Pockets Rent to Retirement. I don't know if you guys know of that.
I heard of it. I haven't been part of it.
Yeah. So basically I feel like you kind of buy high, but they do everything for you. We've never seen it. I've never been to Missouri. It's kind of nice, but I was like telling my husband we were looking at another one. But I'm just like, it's like we're buying so high, like they're doing more of the work, but it's like we could do that. It's difficult.
now you're going to have the education to do it and you'll have us behind you to help you with each step. So I like it. I love that.
So, I mean, I feel like it helped us. We like the market in Kansas City. So it kind of helped us narrow it down but now it's just finding, instead of having someone do all the heavy work and buying high, and now we're making
you're taking out the middleman.
Exactly. Yeah. So I'm
awesome.
hoping to, because I still feel like that's a little bit passive,
Mm-hmm.
So I'm hoping
But
to get active.
a quick question, you know, I was as Lindsay, you start with a D class property, D class neighborhood, but as a new beginner, what do you suggest? What type of C class should we start
Yeah,
with?
I
C class, B class?
I do not suggest D class for anybody. I do not suggest that even
What do
for
you suggest?
I suggest looking for the C building in a B to A neighborhood. So you want to have a good area that needs to have a fixer upper, because you already
Oh,
know that
okay.
values are there surrounding it, and you can find that one that you're going to be able to really force the appreciation. That's really what Michael and I are targeting now. Nicer areas, but with a bad house that you can fix. But I mean,
B
again,
or
you
A
don't want to be
class.
so active. You can just get more of the turnkey. You're just going to be paying a higher price point for it with a little bit less cash flow than when you buy the crappy ones yourself and fix them up. But that's more of the risk, right? More risk, more reward if you're doing it right. So again, and this is different for everybody. But what about you, Zan? Last but not least, you're just on the end of my screen.
I think I'll probably kind of mix of both. I think that I really interested to become active investor. But I learned some passive investment from you guys, and I also learned from prior experience. So probably both, and I think it's not kind of contradicted each other. It's kind of complementing each other.
Yeah.
Sometimes the market isn't correct, and passive income could make good sense. Yeah, but I think I'm still learning and a lot of the ropes and yeah, so I think the mix of both, yes.
All right. I know it's 9:23, so we can get it Lauren's the rest of it here. I'm sorry, guys.
Yeah. Sorry, we went a little bit later, but I think you guys all know what the action steps are, and I know Jose's already read ABC of Real Estate. So I'm going to walk through now a live review of a rental. I think what I wanted to do with this is to show you guys, if you're just have identified an area, grandma lives in Shelbyville, Tennessee. I want to be able to write off my trips to visit her. I hear it's good from a population, business friendly, etc. How do you start to look at rentals? So this is going to be a very high level walkthrough so that you can start to understand very basically just where to start. All right. Excuse me 1 second. Let me pull up.
Oh, let's get a group picture real quick while we're here before anybody drops off, because I know it's
Okay.
Everybody looks so nice on the screen now, popped up in big here.
All right,
Lauren,
let's take
do
it.
you want to take it?
Oh, sure, I'll take it. Ready. One. Oh, sorry, guys. Sorry. All right, here we go. 1, 2, 3. Okay. So this is going to be quick, guys. I'm telling you, Liza, I know you need to drop. If you can hold for like 5 minutes, this will be fast. But I do want to share this with you because I think it's really impactful to getting you started. All right. Here we go. Okay, so as I mentioned, you guys, I just want to get you started, get you started underwriting, get you moving in terms of figuring out how all this works. So Shelbyville, Tennessee, I happen to own property in this area. Can you guys see my screen, the map right now? If you guys
Yes, ma'am.
aren't familiar, Shelbyville is a town south of Nashville. Tons of new jobs. If you guys are thinking about Tennessee, Jose, I know you are. This whole region, I'm telling you, Nashville to Alabama, the next 20 years are going to be very good too. Tons of we got 8,000 new jobs coming into the Shelbyville region alone, from Springfield down to Shelbyville, and then even into Lewisburg. So tons of jobs, population growth coming in here. My agent in Shelbyville had 3 Californians moving there in the next month. So there's tons of people moving. So I like it. I already have property here in Shelbyville, which is why I wanted to target it and show you guys. So let's say you've identified, I like Shelbyville. I want to maybe buy some rentals there. So where do you start? So where I start is you zoom into the particular area. This particular area, let's say grandma told you this is the best area to go in Shelbyville. If this is the town that you got into, we know Shelbyville, the fundamentals are there because the jobs are growing there and the population is growing there, et cetera. And new schools are coming in there. It's a great spot. Okay, so we're in
And
Shelbyville.
quick
I
question.
know that the best.
when you talk about that's the one of the best area, you already did your math. Like, we will always get a one person on the single family home in this area. You already done all that homework,
Not
right?
always. Not always. No, when I say it's a great area, I mean from a population, business friendly, and good schools, low crime rate. That's what I'm referring to. I've identified this area as being one of the areas with those things. Now it's a matter of, all right, I've identified that. Let's look at the numbers and see if it's a good place for rentals. Okay, so
Okay.
that's what I'm referring to. So,
And
it's sorry, you can give me 5 minutes. Okay, so scrolling down, so we know the best single family rentals, generally speaking, are between 1,200 and 1,600 square feet. And I say that because generally speaking, you're going to get young families in there. If you get much bigger than that, you tend not to get the rental income necessarily to make it worth it, from a maintenance standpoint. So just kind of bear that in mind. Between 1,200 1,600 square feet, great single family rentals. So I went in here, I said 1,000 square feet on the low side, 1,700 square feet, 1,750 square feet on the high side. So that will get rid of a lot of the rentals that are just going to be too big or too small. All right, so we click apply. So now we are looking at these are the rentals that are within that wheelhouse. So let's see here. You've got this rental here. Sorry, of course, it's not wanting to pull up. This one you can see here, it's not built yet. I don't want to buy anything that's not built. Anything I buy, I want it to feed me income right away. So I got rid of that. I'm not gonna, that's not one that I would consider. Here's a 3-bedroom, 3-bath, 1,500 square feet. Let's click on this one. All right. So this is a 3-bed, 3-bath, 1,500 square feet. General, and scroll down here. Built in 1962, but it looks really nice. So we can see here, the home was something to see, totally remodeled with all the extras. Been on the market for 3 days, and the lot is about is 0.4 acres. So okay, so that's great. And we know if we flip through the pictures here, we know that it's newly remodeled. Everything looks great inside. So okay, the next thing I'll do is go over to my Rent-A-Meter, rentameter.com. This shows you what the basic rents are. There's a paid version and a free version. If you're just starting out, you can use the free version. You don't need to go and start paying for softwares. So let's go ahead. I'm gonna copy and paste this this address. Shelbyville, Tennessee, 3-bed, 1.5 or more bathrooms. Okay, so the reason why I'm doing this is I want to check and I want to see what the general what the general average rents are in this neighborhood. And that's why I'm checking this. And I know it because I have property here, but I'm going to show you guys how I would find out if I didn't. So let's check the rents. So it's showing average rent in the area. Now, I'm just showing you guys this for basic purposes. You're going to get much more granular if you actually decide to move forward. But if you are on a high level, just reviewing a market for the first time, and if you're in a place where like, I just want to know on a high level, if this is even a good market for rentals, this is a great place to start. So let's say the average rent is $1,671. On the high end, it's $2,271. This is a brand newly remodeled house. So if I was just estimating it, I'd say, okay, I could probably get on the high end of the market because it's a newly remodeled home. So I'm going to estimate, let's say, on the higher side of this, let's say $2,000. So can you guys see my screen here?
yes.
All right, so let's go ahead and get into it. This is a cash flow calculator. You're going to see this in module 3.2.1. Again, this is a very simple module, simple calculator. Michael goes deep into underwriting if you want to really get into it. If you're just analyzing properties, this is a great quick spreadsheet to use. So the monthly rent, let's estimate it, it's going to be $2,000 because it's on the high end here. The purchase price, if you were to pay the purchase price of the property, $429,900. 29,900. All right, it doesn't need any rehab work. The down payment would need to be $107,000. Most of the time, most lenders, if you're lending on a rental property, Most lenders require 25% down. So just bear that in mind. Have that in your head. If it's a turnkey property, generally you're going to have to put 25% down on a rental. So let's come on down here and continue to look at it. And I'm going to go all the way down here. You can see that the property sold for $255,000 last year. And so over the past year and a half, the owner has been really renovating it. So let's stop here. Because I don't know, I'm new to this market. I don't know exactly what the property taxes and insurance are yet. So I'm going to go off the estimation. Again, we're going to show you how to really make sure you're looking at the right property or you're looking at the right numbers, but we're just estimating here. So let's estimate that the property taxes and insurance are going to be what it says, $343. Okay, so we'll go over here and say negative 343. Okay. Again, this is included above. And the interest rate, the debt service with this calculator is at 7%. If it's less than that or more than that, you change it down here. So again, let's say that the interest rate that you can get on this rental is 7%. Your debt service is $21.45. Management fee, let's say you want to use a property manager, it's 8%. So you're looking at total expenses of $2,700. So this property, if you paid the price that they're asking, would lose $908 a month, would lose 10 grand a year, and give you a negative return on your capital. This is not a good rental. So this,
yeah, I mean, the quick napkin underwriting without even putting any of this into the file, you can see right from the sale price versus the rentometer, it's not meeting the 1% rule. Me, I would have stopped there and just moved on to the next property without going into this. So that's why we say that very simple napkin right from the get-go. If it doesn't meet the 1%, don't spend time even looking into it further.
Right, exactly. So now that we know average rents on the upper end of a, let's say average rents are $1,671. Okay, so let's go back into Shelbyville and see how many properties we see for the $167,000 price.
Always start from the end. That's the way to reverse engineer, like as just Lindsay says, always go with the 1%. It really clarifies everything, end goal, it's going to meet the end goal or not.
Exactly, right. So you have a ballpark. So I just wanted to show you this. When I first started out, I was going through these sorts of calculations constantly. I mean, I probably underwrote 300 like this when I first started out. And then you start to, in the markets that I was considering, to figure out which markets I wanted to focus on. So this is something that when you go into module 3.2.1 and then the other modules in there, it really drills down into underwriting. So I think a lot of people on here are deciding on which markets they want or which areas they want. I wanted to provide this quick calculations for you so that you could have the tools to just get started. I mean, if you're really serious, you should be underwriting 100 of these a week. I mean, it's if they meet the 1% rule or at least close. Now, bear in mind, this property back when interest rates were 3%, it looked a lot better. It still loses money, but it looked a lot better. So some of the properties I bought when interest rates were 3% didn't meet the 1% rule, but my debt service was so low, it still worked. So, just keep that in mind, that it's very, very interest rate dependent as well.
Earlier, I mentioned synthesis. When you're starting out, this is all you need, this cash flow calculator. You don't need the big crazy synthesis. This is,
and this whole process called underwriting, the one you're showing us.
Yes, that whole thing is called, it's known as underwriting.
Basic underwriting, what Lauren did.
Just to break down everything. Okay, got it.
So the particular, module 3 focuses on single family and getting good at single family underwriting. Module 4 will get into multifamily. Jose, I know you have more interest in multifamily, but it's always good to just get started on, just getting your wheels turning on the single family side of things as well. So, and please do watch those all 3 of the underwriting modules that we put into module 3. Because
Michael put a lot of effort in. I mean, he really gets into it.
Yeah, there's a lot of nuggets in there on both end, not only on the actual numbers, but also on when you're quickly looking at a property, schools, how to figure out if it's good school system, things like that. So make sure you're focusing in on those when you get into module 3.
Is this Excel template available for us?
Yes, it's under module 3.2.1.
Okay.
Good with knowing the module numbers, Lauren. I don't know them.
I've gone through these a couple of times. If you can
Lauren, it
know,
was in
I
two-
still need
in
my
2.1?
like, which module was what?
Yeah, it's 3.2.1.
Oh, 3.2.
And Lauren, you know, when you was talking about these underwriting, let's suppose is going to work for Kansas or Pennsylvania, you know, but you was talking about, you or Lindsay was talking about one thing, you know, we also need to know which states are landlord friendly. Is that part is not going to cover right here in these underwritings, right? We also need to know which states, and that's what you're going to like. Kansas or Pennsylvania compared to Texas. Texas is not very landlord friendly, you know, right?
California, New
Oh,
York.
Texas, from what I understand, is landlord friendly. It's just your property taxes are high and the values are high, so it's tougher. But yes, module 3 will get into those details. Yes.
Okay, and that's one of the part we need to also look into it when we go for investments, right? Land. Okay.
Absolutely.
Like I always say, I've said to many people, if there's a certain area that you like, I mean, Taylor's already invested in Kansas City, so she already has some people there. But, you know, if there's a certain area where, hey, my sister lives in Indiana, you know, my best friend lives in Athens, Georgia, you know, that because when you go and visit, if the numbers work, when you go and visit, you can write off your trip and you have a place to stay and it turns into something really fun. So
I'm going to Florida tomorrow, and it's a real estate event with some of our partners. The whole thing is a write-off. Or, you know, it's great.
That's great.
So everyone, module 3, again, I know a lot of you have gone through module 3, but please do go back and do those underwriting or review those underwriting modules. We spent a lot of time drilling those down, and every lesson has the spreadsheet attached to it, Zan, so you know the spreadsheet that was used in the lesson. So you'll be able to grab that. And again, if any of you have any questions, please reach out to Lindsay and I. We're happy to do one-on-one sessions with you. I met with Jose earlier this week for a quick one. Happy to do it at any time. And it is Lindsay and I's goal to get you all into whatever property situation that you want, and we have the tools to help you as you're doing your homework and watching these modules.
I encourage you to, if it's a basic question, not about a specific house you're looking at, ask it in the group chat too, because if you have a question, most likely somebody else has the same question. So please use the text message chat to ask questions, or the Facebook group, you know, so we can answer everything. It's a good resource too. So don't be afraid to ask the questions.
Do you personally, Lindsay, Lauren, use like those foreclosure websites like the treasury.gov websites, or
I have when I first started out. I didn't buy any on the foreclosures, but I definitely looked through those websites a lot when I was first starting.
Got it. But that's you mostly look, I guess, at other sources for your real estate, not the foreclosure websites, but at other
Correct.
places.
Yeah. And we'll get into the prop finder, and I'm going to do a module in the next week about how I do my direct mail campaigns and target these old mom and pop sellers they're not going to be listed on Zillow, right? And that's how we've gotten our best deals. So that's a whole other thing we're going to get into.
I'm gonna go to a nurse. I'm gonna go to a nursing home and just start asking these old elderly people, like,
hey,
hey.
you know.
I never thought to do that, Jose. That is a great idea.
I'll probably get fined for soliciting or something.
Yeah, you probably would be. But yes, I mean the off market. I mean, Lindsay's going to do an entire section lesson on this too. But those off market deals, you know, tend to be where the best ones are. So she and Michael have honed in on that. So all of that is to come. So again, I know a lot of you have like skipped ahead, but we'll be letting you know where content has been added. All right.
Thanks, guys. Sorry to keep you late.
I know it's expected.
But it's all good info. Thanks for everybody for the conversations tonight. And again, please ask questions in the group chat, or if you know, you find a property, you're like, hey, this just came up, can you look at the numbers with us? We're glad to do that too.
Thank you.
Thanks, guys.
Have a great night.
Have a great night. Bye.